Well, in just a few short weeks from now, summer will be ending, September will be here, people will be going back to school, and beyond the normal events that happen in the fall, there's one significant one that is on tap. That is the end of quantitative easing. Here to tell us what that means for you and what that could be triggering in terms of a longer-term outlook, we're joined by Craig Alexander. He is Chief Economist at TD Bank Group. I like to start off with simple questions. That's a nice simple question, isn't it?
It is a very simple question. It's just a complicated answer.
Fair enough. Okay, so let's just back up and set the stage. QE has been in place for how long?
So the Fed has been buying bonds for several years now, and if you actually look at the total amount of fixed income assets they've accumulated, they've now accumulated on their balance sheet $4 trillion worth of fixed income assets. But the good news is that they have no intent on selling those assets in the marketplace. So they're not going to, when QE ends, they're not going to start unloading their position, which would of course cause yields to increase quite dramatically. They're just going to hold those bonds until maturity. But
right.
The end of QE is very important because I think what we're going to see is increased financial market speculation about, now that QE is done, when's the first rate hike going to come?
Okay.
And I think that's where we're starting to hear an awful lot more debate, in terms of the timing of when the Fed will eventually start to raise rates. And then the second dimension, which I think is the more complicated one, is when rates rise, just how high could they go?
Okay, so I'm going to again try and couch this conversation in, I am an investor, I am, got part of my assets in fixed income, I've got some in equities, I care about interest rates, obviously, from the fixed income portion. What the heck is going to happen?
And there are diverging views on this, but I think the consensus is that the Fed is going to be very slow in terms of how they raise rates. Okay. And I think part of the reason is going to be that the pace of economic growth is expected to be moderate. It's not going to be booming, and there isn't going to be big inflation risks, so no real urgency for the Fed to act quickly. Number two, the Fed actually has to drain some reserves from the system. They've accumulated an awful lot of assets on their balance sheet, and at the same time, they are going to want to get the interest rate, the Fed funds rate, that's currently on a range of 0 to 0.25%. They actually want it to get up towards the quarter point before they start doing the tightening.
And just to be clear, so there's the Fed fund target rate, then there's an effective rate, so which is what actually is going on. Right. And you're saying the effective rate is nowhere near where the range is right now.
So the range right now is 0 to 0.25 point. The effective Fed funds rate, which is what people are transacting at or institutions are transacting at, is about 9 or 10 basis points. What they'd like to do is they'd like to have that effective funds rate up towards that quarter point target. And because once they get it up to that quarter point target, then they can start raising rates, and they can actually say, okay, we're going to announce the Fed funds rates going up from a quarter point to a half a point. And so they will have control over short-term rates. And I think that's going to take some time to get the effective Fed funds rate up off of 10 basis points up to a quarter point. I actually think they're going to want to do that incrementally and in a way that won't be disruptive to the financial system. But then the question is going to be, all right, so once they've accomplished that, when are they going to start raising? And in one of her early testimonies, in fact, I think it was her first press conference, Janet Yellen was asked, okay, so after QE ends, how quickly will you be raising rates? And she tried to avoid the question several times, but then when she got cornered, she said, well, maybe about 6 months. Now, you look at a calendar. If the Fed's going to be done in October, and that's what they've signaled, the end of QE, 6 months later is April. That seems a little too fast. Well, I think they have to get the effective Fed funds rate up to the quarter point, and I don't think they're going to want to do it in a rush. And I also think that the economy probably isn't going to be giving them signals that that there's an urgency to move up rates. I actually think a very plausible timeline might be, for example, starting in June. And the reason why I like June is a meeting where they're going to have a press conference. They're going to have new economic projections. It's just before their Humphrey Hawkins conference. And so in other words, if they signal to markets that, get ready for a hike in June, and then they hike in June, they'll have lots of opportunity to explain to markets why they're doing it, what the implications of it are. And I think they'll try to temper expectations to basically emphasize that while rates are going up, they're not going to go up very sharply, and the level of rates probably won't be terribly high. So I think you get a quarter point maybe, in June, and then you get another, quarter point or two later in the year. But then I think they stop because we've had such a low interest rate environment for such a long period of time. It would be shocking, I would
think, to have them go too high.
Right. This is going to be a real shock to...
This is a world awash in debt.
And this isn't, financial markets are going to have a challenge getting their head around what are the implications of the Fed now actually raising rates. But so will the real economy. I think that, if we think about young individuals that have been, in the real estate market and bought a house in the last few years.
Aren't rates always at 1%?
They think this is normal.
Yeah.
And so I think central banks around the world, this isn't just a U.S. story, but when interest rates rise, for example, in Canada, I think that the central banks are going to have to be very careful about how they go about raising rates. So for fixed income investors, it means on the one hand, bond yields should rise incrementally and gradually over time. But the level of interest rates, the level of yields, should remain well below sort of historic norms, well below what they were before the financial crisis. And what that means is that because when bond prices, when bond yields go up, it means bond prices are falling. It does mean that there's going to be some capital losses on bonds. So bonds are not going to be delivering a return equal to their yield. But you're not going to see large-scale losses because the increase that we're going to see is going to be very incremental. It's going to be very slow. It's going to be very drawn out. So, for example, I don't actually think we're going to get back to something in the Fed funds in the sort of around the 3% mark. I don't think you're going to see that until probably something like 2018. So, in other words, this is going to be a very slow, very drawn-out process. So, good news, yields will get a little higher. The yield will be higher than the rate of inflation. The bad news is that you'll lose some money on your current bonds, but the amount of money you lose on the current bonds is going to be pretty incremental because the Fed is going to be very gradual in the way they raise rates. And I think for Canada, I think the Bank of Canada, generally speaking, is going to move in tandem with the Fed. It won't be perfectly aligned. It could be a meeting before, it could be a meeting after, but in broad strokes, the Canadian fixed income markets are going to follow what happens in the U.S.
Craig, thanks so much.
Well, it's been a pleasure.
Craig Alexander, he's Chief Economist at TD Bank Group.